The moment a piece of money crosses a national border, its purchasing power morphs. A single unit of currency that buys a full meal in one country might barely cover the tax on a cup of coffee in another. The numerical disparities appear puzzling at first glance. Currently, 1 Kuwaiti dinar equals over $3. Meanwhile, it takes roughly 155 Japanese yen to buy that same American dollar. This chart shows the massive gap between a single currency unit's value and a nation's actual economic output. Kuwait's single currency unit is over 3 times more valuable than the US dollar, yet the United States economy produces nearly 180 times more output. Japan's single unit is worth less than a cent, yet Japan generates over 25 times the economic output of Kuwait. Absolute nominal numbers reveal almost nothing about national wealth. Real economic power exists independently of the name on a bill or the zeros on a note. To understand how these values are actually set, we have to look at what currency is designed to do. For thousands of years, trade relied on barter, which required a coincidence of wants. You had to find someone who had exactly what you wanted and wanted exactly what you had. Money emerged as a universal intermediary tool to eliminate that friction. Modern fiat currency derives its value from government decree and institutional trust, rather than physical commodities like gold or silver. It has no intrinsic physical value. Monetary sovereignty acts as a vital macroeconomic lever. Giving up that control limits a nation's ability to respond to a crisis. When Greece adopted the euro, it lost its independent currency. During the 2010 sovereign debt crisis, Greece was unable to devalue its own money to boost exports, forcing the country into a brutal internal devaluation, slashing public wages and pensions instead. Maintaining a distinct national currency acts as an automated shock absorber. When an economy slows down, its currency naturally depreciates, making exports cheaper and inviting foreign buyers back in to rebalance the trade flow. Exchange rates are decided in the foreign exchange, or forex market, a decentralized, round-the-clock arena where commercial banks and multinational corporations trade $7.5 trillion every single day. This diagram shows how those daily valuations are calculated. In the forex market, a currency is treated just like a commodity. If international demand is heavier than available supply, the exchange rate value rises. If supply outweighs demand, it falls. Global investors evaluate that supply and demand through 7 distinct macroeconomic pillars, including inflation, political stability, and foreign direct investment. Central bank interest rates act as a primary driver. High interest rates attract foreign capital seeking superior returns. Investors borrow money in a currency with near-zero interest rates and buy government debt in a nation with high rates, a mechanic known as the carry trade. A country's trade balance also impacts valuation. When a nation exports high-value products, like software, airplanes, or oil, foreign buyers must buy that domestic currency to pay for the goods, creating a continuous, structural demand for that money. Ultimately, a currency appreciates when a nation's underlying macroeconomic conditions make its money a highly desirable asset for the rest of the world to hold. The US dollar dominates global trade due to the scale of the American economy, the deep liquidity of its financial markets, and its history as the default pricing mechanism for global commodities like crude oil. Kuwait maintains a dinar worth 3 times more than the dollar through a specific combination of factors. They generate massive global demand via oil exports while simultaneously restricting the total supply of circulating units to keep the unit value high. While a high valuation seems ideal, manufacturing powerhouses like Japan, South Korea, and China actively seek a different outcome. Exchange rates act as a double-edged sword. While a high valuation makes foreign imports cheaper, a lower-valued exchange rate provides a massive competitive buffer, allowing export-oriented nations to flood the global market with goods at hyper-competitive prices. For export-driven economies, a low-value currency functions as a deliberate, weaponized strategy for dominating global trade. If an exchange rate falls too fast, central banks will step into the open interbank market to defend their currency. They spend their stored foreign reserves, like dollars or euros, to purchase massive quantities of their own money, artificially boosting demand. This defense mechanism has a strict mathematical limit. While a government can print an infinite amount of its own money to weaken its currency, It must spend finite foreign reserves to strengthen it. Once those reserves hit zero, the defense collapses. These macroeconomic policies unfold over months and years, but the actual price of money changes every single millisecond. High-frequency algorithms execute over 70% of modern forex trading. If a geopolitical shock hits an oil supply chain or an inflation report misses expectations, these systems react instantly. They buy or sell massive currency blocks in milliseconds, creating immediate spikes on financial screens. Long-term currency values are built on slow economic fundamentals, but short-term prices remain entirely at the mercy of global psychology and digital execution. The numerical unit value of a currency, whether 3 dinars or 155 yen, is an arbitrary administrative choice. It reflects the division of the money supply, not the scale of a nation's real economic wealth. True monetary strength originates from a complex mixture of trade flows, inflation control, investor confidence, and geopolitical stability. Exchange rates represent the living, breathing price tag of global trade.